Good evening, ladies and gentlemen. This is Clueless 8, and this is the end of the day report for September 21st, 2015. Let me give you a quick overview of what I think is going to be how the week is going to shape up and possibly the end of the month. I know I've covered it in my previous video cast, but it is important that after Friday's and today's action, I didn't get a chance to do the end of the week report. My apologies. Um, so this should take care of all that missing missing forecast. So here's a picture of the S&P 500. This is really critically important because every trade that you do out there, in the form of whether it's a Priceline or an Apple or a Goldman Sachs or index trades and ETFs, it's all held hostage to what the backdrop is doing, and that is your indices. So the S&P 500 is a good one to look at because that dominates the field, both psychologically and technical, on what the market is doing. So here we have, and I'm going to reiterate, here we have the October lows, October 14th lows, right there of 2014, which was, again, I repeat, one of the best generational opportunities to make money. This move alone, and I know many of you have heard this many times, but I will still repeat that a minimal investment, whether it be in the indices and some of the power momentum stocks, would have generated in excess of 1,500, if not 1,900% on your money. So that means if you do that math, then $10,000 here would be close to 200K up here. Sounds absolutely phenomenal, doesn't it? But you know what? Crap happens in the market. But point is that no one knew we were going to have this monstrous rally after this sharp decline that we went through on because of many different factors. Ebola, it was the high yield junk bond fallout, worries about U.S. oil prices, whole bunch of other stuff, you know. But specifically, the credit high yield situation is what caused this type of pull down. Similar to what happened here, to be honest with you. Okay. But here was a bigger drop because the oil had dropped precipitously. There were a large number of smaller hedge funds, if not sovereign, that state owned hedge funds known as sovereign funds, which got into big trouble. Massive margin liquidations and a straight line drop. You don't see these too often. Let me just tell you that. So the bottom line is that at this point, um, this is what I'm seeing. So here's October lows. We never got down on the S&P to the October lows, by the way. That was 1820 or 1819.6. We got to 1867, and honestly, I did expect it to come down here. But you know what? Pattern symmetry doesn't mean it's going to happen exactly at our time. Can it happen again? It sure can. So let's look to see what's going on here. This is a daily chart, so it lends a lot of credibility to what's going on. And here is what we have in front of us. We have a doji formation here. It's not really a reversal candle, kinda, but it's more of a doji formation in my opinion. And the markets ended, printing up 126. We all know what we did today. People who need to know what we did today, simply go over, click on, which you should be anyway, click on the Twitter real-time feed and see how well we did. Aside from Netflix, which was down, every single stock that we played today, including the indices, were huge gainers, both on the short side and the long side. That's the nature of the biz. S&P puts almost 8 to 9 points. Okay, bagged, banked, and then turning around, buying the calls, up more than 4 points. So right there is 15 points for discipline, focused, and and I should say active traders. Whichever the case, it's not a straight line up or down. There's a lot of zigzags along the way. So at this point, this is what I see. Look what happened here. This is an uptrend line from the August 24th lows. All right. So let's look to see what the charts are saying. So we hit it there exactly, and then we got rejected. The rejection wasn't that bad because we didn't fall apart, which would be really bad. If we fell apart below 1952, then we would have hit that 1940 level, which wouldn't be bad. But then it would open up the door to test this sub 1920, let's say 1918 level. Now, what does it mean to a lot of people who are trading stocks? What it means is that it doesn't matter what you bought, you would have been creamed, you'd have been hurt. But there is no guarantee whatsoever that we're not going to test that, because at this point, this was a bear flag as of Friday. It still is a bear flag, to be honest with you. However, you can spin it in different ways, and I'm going to show you this. All right. So you can spin it. If a bullish spin would be, hey, this is this reversal thing, which was certainly not good on Fed day, is simply a consolidation channel, or a let me just draw this out. So one could say this is a consolidation channel. Well, if it's a consolidation channel, we're still looking at about 1920 on the S&P. That's another 46 points from here. So that's another 300 some points, if not more. So the bottom line is it possible we get back down there? It is. That's a possibility. And I'm going to draw the line right here. This is a major support or reversal support right here. Okay. That's possible. Is it possible that we come down and test this reversal level at 1903? In other words, the 1900 retest? That's possible. However, if we stick to the bullish scenario that this is simply a consolidation channel, and this gray line here is your drawing this out here a little bit. Okay, this gray line here is a pretty strong support. And if you really squint your eyes a bit, you'll notice that this is starting to curve up. There's a lower end of the acceleration band. This is starting to flatten out. And of course, this is still downward trending. So if this is going to act as support, so we're looking at about 1954, 52, that's another, let's say, 140 points or so that holds as support before we make a sharp bounce. Now, you got to mix this video cast in with some very precision S&P charts, SPY charts that I've shown clearly in a different format on TradingView. And if you guys can remember what that is, that means you're not following my work to any degree. So I'm going to try to pull this out. And this is your TradingView chart right there. There's a lot of stuff going on here. But people who have, again, I got to repeat it, people who have diligently worked with me, and I've spent enough of my own family time working with people on the group coaching sessions on the weekends. They know very well what this chart is all about. You got some lines here, and these lines means a lot. You know why it means a lot? Because it makes money, both on the short side and the long side. Now, the real precision work during intraday, where I'm calling the shots on when it's going to turn and how many points to get out of on the S&P, leave it to me to do it for now. I'm sure some of you are catching up to it, and I'll probably be out of a trading service job. But that's okay. I have a great trading book, and I'm not too worried about that. But congratulations to all that who participated and can read the charts to a very fine degree. But on this one, for example, what I see here is this. You have a Bollinger here. You have a Bollinger there, which also happens to coincide with this downtrend line. We certainly don't want to break below the Bollinger in the downtrend line, in which case 190 comes into play in a big way. If we do move up, and there is another downtrend line here that I'm drawing out for you all. Sorry, it's not a downtrend line. Sorry, this right here is the 50-day moving average. Okay, and this is on the 4-hour chart. So if this is the 50, the 50 moving average, simple moving average. So if we break out over that, let me get the drawing tool out here again. If we break out over this, then we are going to make a move towards testing the back end of this rising uptrend line. That's a normal things that happen. I've been doing this for many years and I've seen this happen over and over again. The question is, how quickly do they happen and at what timing? That's my job to alert as timely as possible. And so far, I've done a pretty damn good job. Even though these volatile markets with algo HFT programs hitting in waves of buy and sell every couple of minutes, every 15 minutes, half an hour, is not an easy job. But hey, I'm still doing it. So here you have the upper Bollinger where you have the red arrow. People may wonder, why is the red arrow? The red arrow is there because that's upper Bollinger, which will act as resistance. And that's around SPY 200, which would be fantastic for longs. You got a scalp, 40 S&P points and 4 SPY points up here, right there. Okay. If we break out over the yellow line here, the orange line, I should say, then we are looking at a gap fill. This is a gap. And this is a gap fill. I've marked that in many of my other charts. And the gap fill there is 204. Wow, people get really super duper excited, right? At 2040, they're like, wow, this is roughly about 2040 here. But you know what? At that point, there could be a large rejection, come down, test this broken, test this lower gap right here, and then maybe do that. We don't know yet. All I know is one point or another, sometime between now and early October, we should complete this pattern. That pattern rules out to about 2100 or 210 on the SPYs. Is it possible? It's a good possibility. Now on the 4-hour chart, the other thing we're noticing is this thing here. Okay, let me clean up the screen a bit. So this thing here is telling us that we are starting to see a stochastic reversal. It doesn't mean it can't just, kind of bounce around here before it goes. But one way or the other, the markets are going to get overbought. And that means we're going to get it somewhere between a 300 to 400 point, if not a more type of rally, which brings us up to possibly close to 17,000 again. Remember, these type of what do you call, oversold conditions do relieve themselves. Sometimes they take a little bit longer. This was a prime example. We did very well in this extreme volatile zone, if you remember. If you don't remember, pull up the trades up on Twitter, go to clueless8.com/charts, and you'll see it. Listen to my video cast. We did. So at this point, even though the pattern is not the most constructive, we are simply kind of staying within this range. As long as 194 or so holds, we should be able to bounce towards 202, if not 200. If we break this, we're going to, first line of support is going to be a downtrend line retest. And then, of course, we have 190 here. And of course, we break that, then we're going to be testing these. So that's your long and short of what's going on. Now, this particular week, I feel that we have some very pivotal events. Wrap this report up soon. And that's we have Dennis Lockhart speaking tomorrow at 7 p.m. Speaking a lot, actually. He spoke at 1 p.m. today. He speaks again tomorrow at 7, and then he speaks at 12:30 on Wednesday. Wow. He's like a triple whammy here. A bad comedian. No, he's a great Fed governor. And then we have the star act. Janet Yellen speaks at 5 p.m. after market on Thursday. I believe that any pullback that we see prior to Thursday, let's say we get the Wednesday red day pullback, should set us up for a strong move up into Friday. And there is at 1:25 p.m. another Fed governor, Esther George. Oh, two of them, James Bullard at 9:15, Esther George at 1:25 p.m. These are very important because these are volatility clusters, which move the markets big time. Bottom line is, you'll need Clueless 8 trading services and alerts more than ever to navigate this market. In the meantime, I intend to make very decent sums of money, both on the long and short side. Keep your positions tight, keep your positions smaller, don't go overboard, and let's go from here. All right, that's it for now. Thank you for listening.